Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you, giving you the sincere and actionable ideas that you need to improve the lives of yourself and your loved ones is what we do every single Sunday. And I always bring in talent to sit with me side chair. I can't think of anyone better than one of our practitioners, David. David's here with me on a Sunday morning. And I want to talk about what it means to be managing your wealth in the new economy, right? Managing your wealth in the new economy. And that's not just an investment thing, it's an everything thing, because again, at VestGen Wealth Partners, we're a multifamily office for everybody. That means multidisciplinary specialists all coming together under one roof to serve a shared client base, whether it's investments, income taxes, cash flow modeling, retiree healthcare, the discipline of both goals-based and cash flow-based financial planning, long-term care. Oh, wait, what about this thing? I call it responsibility. Because if you've got people that you love and they love you back, then you absolutely, emphatically need to create agency. That means protect choice for yourself. And you need to make sure you're not just leaving monies to the ones you love. You need to message. Messaging means putting the ones you love in a position to be successful. And that starts with something so simple and so easy like planning for healthcare. So America, listen up. There's executors, there's trustees, but there's also these really cool people. They're called agents. And your agent is your advocate. Your advocate is your best friend in life, your husband, your wife, your brother, your sister. It could be an adult child, but you're going to go ahead and create that durable power of attorney for healthcare. You're going to designate agents and you're going to include really important items such as HIPAA waivers. David, what are those?
Yeah, it's the form that everybody signs when they go to their annual physical, right? That full release of medical information so that, for example, if I'm laid up in the hospital, I want my spouse, Brooke, to have full unencumbered access to my medical records. Maybe she wants to get a second opinion because, there's something goofy going on. So that HIPAA waiver is super important, especially these days. And the key with this stuff, Craig, too, is a lot of this stuff is now statutory, right? So there's not a tremendous amount of customization in these documents, but we got to start checking the boxes. So if you did your documents 20 years ago, they might not be up to today's standards.
That's exactly right. So we're talking about all things that are responsible, and that begins with legacy and estate planning. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. And when you're there, download our legacy and estate planning guide. So rounding out document number one, these are documents you use while you're alive. Everybody gets a durable power of attorney for healthcare. Everyone names some agents so that we can be advocated for. And again, consider delivering not just to your agent, but to other people, those HIPAA waivers that allows people not to be in a decision-making capacity, but it allows those people to have access to the medical records to help manage the care, speak to physicians, etc. While there's a healthcare document, there's also a financial document. And David, that financial document is so critical because we use it all the time as practitioners. It's the second document everybody gets while they're alive. And what is that?
Yeah, that's durable power of attorney for property. To your point, I think a better title for it would be financial power of attorney because it does handle all of the finances. So if we play that example out, I'm incapacitated. I've named my spouse to act as my healthcare agent, my advocate. I also want to make sure that my spouse has the capability to manage our finances. Now, one might think, well, wait a minute, it's your spouse. Wouldn't they always have that capability? Well, in a lot of cases, yes, right? A lot of people have joint bank accounts, right? So either party can withdraw money, but a significant portion of my personal wealth and every American's personal wealth is tied up in qualified retirement plans, 401ks, IRAs. The I in IRA stands for individual retirement account. So trust me, my wife is the primary beneficiary on my IRA. But if she called up 1-800-CHARLES-SCHWAB, does she have the ability to withdraw money if I'm still alive? Nope, unless we have this power of attorney for property already signed and executed. That is a big deal. And that's actually a question that just came up with the client the other day, right? I mean, most families have multiple accounts, and the client had a super basic, but I think super important question. She said, if something happens to one of us, can I just go take money out of anyone's accounts? Can I go take dollars out of his 401k or his solo K plan? And legally, the answer is no, right? So we need to empower these folks because we only get one chance at this stuff.
Yeah, David, that's so important because, again, just because your spouse is the beneficiary of your accounts, a beneficiary has no legal right, no recourse, no action. Just because you're married, guys, I'll tell you this all the time. Have you ever tried to change your cable bill? And you wait on hold, you go through all the prompts, and 49 minutes later, so because you want to change your cable package, you find out that the cable package is in your spouse's name. And if your spouse isn't available, you just wasted 49 minutes of your life. So if people aren't even going to allow you when you're married to change your cable package, change your internet provider, I got news. They're not going to give you access to accounts when it's needed. So make sure, mark this down, you need to have a good, durable power of attorney for property in full force and effect, something that is not aged and dated, but something that is compliant with the new pieces. You darn well better endorse financial institution transactions specifically so that you can make sure your household, your monthly income, all these things continue to function should you get sick or should you get injured. Why are we talking about the easy parts of estate planning? Because it's critical. You know us and you know us well at VestGen Wealth Partners. Again, it's a family office for everybody. That means multiple services. So after we talk about those documents we use while we're alive, there's a document that everybody on the planet gets at death or needs to in advance. And David, that's called a what?
Sure, that's called our will. And sometimes we have a trust. But I got to go back real quick, Craig, to these powers of attorney, right? These are the non-negotiables. Whether you have 10,000 or 10 million, these are documents everybody needs. And what we need to think about is how things have changed so rapidly over the last 10 years. We talk about artificial intelligence and this new economy all the time. I mean, 10, 15 years ago, did people have cryptocurrency accounts? Did they have all these social media accounts? The money is probably the most important thing, but if you are trying to access a crypto account online for a spouse that's incapacitated, we need those documents. So you mentioned the will, the document we use when we pass away. Essentially, the will is the plan. The honest to God truth is if you have beneficiaries on retirement accounts, that typically supersedes that will. I think it's probably a better use of our time if we start talking about trusts. And when I think about trusts, I think sometimes you read or you hear people say like everybody needs a trust. In finance, my personal opinion is we never deal in absolutes. I'm not sure if that's the case, but I think we both agree that trusts are very valuable tools, flexible tools, and depending on what you're trying to accomplish, perhaps a trust could be right for you. Number one reason I see people do trust, Craig, is they want to keep it simple. Oftentimes they're just doing it because they want to avoid probate. What do you think about that?
Yeah, David, I think it's true. Remember, estate planning isn't about giving monies to the ones you love. You can do that with a simple will and beneficiary designations. Estate planning is about putting the ones you love in a position to be successful. And to us, that means a streamlined process. That means avoiding probate. That means if you're financially successful, minimizing death and transfer taxes. Remember, guys, Springfield, Illinois wants a piece of your estate. Don't think that just because the federal exemptions for estate taxes are super high, don't think they're the same in Illinois. They're very low, designed to ensnarl and capture revenue. Trust will help you mitigate away or neuter those taxes. In addition to that, you need to use trust accounts because for me, I'm giving monies to my wife. I'm also giving monies to my adult children. I'm not giving my monies to my adult children in such a way that it's going to leave my bloodline. I'm not giving it to them in such a way that it's going to be subject to creditors. I'm not giving them the money all up front. I'm making sure it's spaced over time, and I'm creating great governance, not just for my spouse, not just for my adult kids, but any and all of my future grandkids to make sure the messaging is adhered to. And a lot of you out there, because we talk to you all the time, feel the same way. So here's what I want you to do. I want you to take what we've been talking about so far, and I want you to turn it into action. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're there, download our legacy and estate planning guide for free. Download our legacy and estate planning guide for free, and then take advantage of a complimentary consultation. And let's talk about what it means for agents, executors, trustees. Let's talk about what type of platform you need to protect yourself and the ones you love. We're a phone call away. That's 833-964-PLAN. 833-964-PLAN. You're listening to Craig and David Bolanos. This is In the Know with VestGen Wealth Partners on AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
You know, we just covered the non-negotiable documents that every family needs to think about as they move into that next chapter, that chapter of permanent unemployment or retirement. We talked powers of attorney for healthcare and property, and then we transitioned into trust. And Craig, I wanted to cue you up. You mentioned this, but I think this is so important for families that work several decades, put in the sweat equity to grow their estates. One of the things that we often hear is they want to make sure that what they've created stays in the family bloodline. Can you explain just a bit more of what that actually means as a practitioner?
Yeah, think about it. Listen, guys, there's equitable distribution states. There's community property states. We're surrounded by some in Illinois. And I want to make sure as I leave monies to my adult children, Connor and Gavin, even though I love to death the ladies that are in their life, I know that divorce is real. I know that divorce happens all the time, and I am not going to put all of the blood, sweat, and work that we did into an estate plan that's going to possibly leave money that can go into my ex-daughter-in-law's pockets. There's just no possible way I'm going to let that happen. And a lot of you feel the same way because of what you've seen. A lot of you feel the same way because of what you've experienced. And again, there's ways to have your cake and eat it too. There's ways to acknowledge, not just with love and affection, but acknowledge with action, these people we call son-in-laws and daughter-in-laws. But I think if you're leaving money and you want that money to stay in your family from your work, then you have a responsibility to put your adult kids in a position to be successful so that the dollars they eventually inherit don't go out the door in divorce. David, is that what you were referring to?
Yeah, if we're thinking about that, that means you guys are doing some high-level estate planning, and you're probably doing that high-level estate planning because you want to mitigate estate or death taxes. And we know that there are certain states that are a little bit easier to pass away in. These are states that have similar exemption amounts to the government. And then there's other states that essentially charge you to die, right? And why do those states like Illinois charge you to die at a lower limit than the Fed? They need the money, right? We're having trouble just keeping the bears in Illinois. And I think that's important because it affects your money, right? The finances of states and the Fed, I think we're trending now $38 trillion deficit. It's starting to become a bigger and bigger deal. We've always run this deficit in the country, but I think that last year, in addition to this tariffs coming through, you really started to see how this deficit could affect the U.S. long term, because it started to affect the treasury market, right? Other countries, when they were trying to kind of get us back for some of these new policies, stopped buying some of our treasury bonds. They looked for alternatives, commodities, other currencies. And I think that everybody out there who's preparing for retirement should really consider how that might start affecting their portfolio, because we really started to see that come through the forefront last year. And if you're a moderate or balanced investor, maybe you have 30-40% of your capital in fixed income or bonds. And we need to make sure that we're allocating and implementing in the correct structure. Craig, what do we mean when we talk about implementation versus, just kind of set it and forget it strategies for fixed income?
Yeah, I think bonds are the ballast in everyone's portfolio, and they're not talked about enough because everyone wants to talk about the fast money. That's the stock market money. But remember, part of getting retired and staying retired is not losing sight of what matters, which is being able to sleep at night. And that's where fixed income comes in. And while someone might say bonds are bonds, it's really a difference in platform. I believe what is great about bonds is when you buy them in the right platform, you know when your bonds mature. That means you know when you're getting your principal back. When you buy bonds in the right platform, then you know exactly how much interest you're going to collect between now and maturity. When you buy the bonds in the right platform, having that guaranteed maturity date with a yield to maturity allows you to avoid the day-to-day noise because you know when your principal comes back to you. But that is only available if you are doing individual bonds or bond products that have target maturity dates. David, the way most advisors utilize them is exclusively bond mutual funds or perpetual bond ETFs. There's nothing wrong with those, but in the absence of being blended with the other things I just mentioned, I think it creates way too much exposure, because just the other week, you and I talked on radio about the tips starting to widen. That means inflation expectations are in fact going up. And last time I checked, inflation is the enemy of bonds. And David, maybe we didn't anticipate things, but we certainly said higher stakes, higher valuation, right? Anything but calm. That's why we kept the duration of our portfolios less than the aggregate. What does all that mean? And how do you as a practitioner actually implement with clients you work with?
We are trying to create permanence and definition in portfolios, right? We are trying to help create defined outcomes in a world of little knowns. It's very hard to do that in the fast money portion of the portfolio, the stock portion, a little bit easier to implement some of that in the safer money portion, which is typically the bonds. And if I think about that in the simplest terms, retirement's about cash flow, right? It's not about assets on paper. It's about what comes in every month versus what goes out. And if I was going to retire, I would like to know specifically from what account I'm going to withdraw from, how is that money going to be taxed, and then I'm going to reverse engineer the investment strategy. And I would want to see where my money, my monthly distributions are going to come from for the next couple of years. And I think implementing these defined outcome strategies creates the clarity that might not exist today. Because the way I always phrase it to people is what's the maturity date on the aggregate bond index ETF or mutual fund? Right? It's a trick question. You don't know it because you don't control it, right? Maybe that ETF or mutual fund company controls it on your behalf. But if we can start to customize, we build in a little bit of clarity. Having some of that clarity about maturity dates is going to make you feel a little bit better, Because assuming no default, you know when you're going to get your principal back, and you know at the time of purchase, by a simple calculation, yield to worst, how much you're going to earn on those investments. And that is what I think is missing in a lot of portfolios, is that clarity as to how it's going to work and when the money is coming back to you.
So David, people are leaning in, they're listening, they're understanding that bonds are not all created equal, dependent upon the platform. What sets VestGen Wealth Partners apart relative to our traders and our fixed income desk, giving us access? Because far too many people who work with the solo advisor model can't replicate what we're doing. Why is that?
Infrastructure. We love infrastructure as an investment, but we've also spent a significant amount of time behind the scenes as a firm trying to build out our technology infrastructure as well as our human infrastructure, right? We always talk about implementation quotient, right? And in getting the smartest minds behind the scenes. Our firm was designed as a multi-custodial offering. So holding capital at different custodians and being able to borrow ideas and being able to access investment solution through multiple providers to give our clients maximum opportunity set. So the difference, Craig, is really simple. If you're working with a shop that has 2 to 3 people at the helm, how could they possibly spend the time to do the due diligence on the fixed income and create the ladders versus an institutional backing like we have that allows people behind the scenes to execute when you and I are in the conference room actually doing the real retirement planning. That is the difference. And that is what we've spent years building, not only because we think it's the right way to do business, but I also think good stewards of capital are demanding that higher level of care moving forward. And that's what we're providing.
That's what we're doing at VestGen Wealth Partners, is giving you a higher level of care. And I want you to have the chance to experience that. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. In our A block, we talked all about what's responsible, the basic table stakes, making sure you have the right legacy and estate planning documents and messaging, protection from creditors, keeping monies through the bloodline. So download our legacy and estate planning guide today, or our supplemental document, which is designed to start creating dialogue so that you too can be comfortable being uncomfortable when talking about these issues with your family, with your parents or adult children. That guide is called How to Successfully Communicate Your Legacy and Estate Plan. How to Successfully Communicate Your Legacy and Estate Plan. That's available for free today at getretiredstayretired.com. So, hey, I think you need to learn more. I think you want to learn more. And David, we talked a little bit about the estate side. We talked a little bit about bonds or for ballast, using the right platform. I think it's time we talk about the fast money component coming up next. You can't afford to miss this. You're listening to who? Craig and David Bolanos. This is In the Know Radio with VestGen Wealth Partners on AM 560, The Answer.
You want more In the Know Radio? You want more In the Know Radio? You can't handle more In the Know Radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
So, David, I teased it up, but we got to talk a little bit about the fast money portion of the portfolio. So, David, what do you mean when investors aren't getting what they need? What do you mean when you say some people are over-diversified? David, talk about all of that in the constructs of how we solve it for the efficacy of real returns at VestGen Wealth Partners.
Yeah, great segue. Look, I get the sense, right, that sometimes there's frustration and people say, man, like I saw the stock market go up, but maybe we're not participating as much as we should be. But we're not here to prognosticate of whether that was due to market timing, over diversification, stuff like that. I think, we got to keep things simple. And if there's a little bit of missing out, one of the best ways to solve that is to start using some low cost passive ETFs to anchor your portfolio, right? Because you need exposure. Everybody needs exposure to the market. But I think what we need to start doing then is we need to complement that with some other strategies. And you had talked on the bond side about what I call it getting back to basics, using very straightforward laddering or staggered process. That's the same way that a lot of capital was built in this country too. Not everybody would buy stock mutual funds. Lots of people used to buy what I call great companies of America and hold on to those companies. Now, when you buy stocks, right, there's no expense ratio, so it's very low cost. But I think one of the benefits of allocating to individual stocks is you also know what you own. And so when times get tough in the markets, when you own a lot of mutual funds, you don't really see what you actually own, and you might lose some of your staying power. You might kind of lose confidence and you just sell it because you don't understand it. But if you own some of these great companies of America, you understand what they do, might be easier to hold them long term. And by holding them long term, then we start that compounding effect. And where you get the compounding effect is if these stocks are generating cash flow and you aren't using that cash flow yet for retirement, we can reinvest those dividends, accumulate more shares, and let that eighth wonder of the world just take over to grow your capital long term. So I think there's a couple things to think about. If we need better participation, we might need to move away from mutual funds into ETFs. If we want to reduce cost, increase tax efficiently, we can lean into those individual dividend growing stocks. And if we need additional tax efficiency, then we can start leaning into additional direct indexing strategies, which is kind of combining all of those different competencies. Direct indexing is a way to try to mimic a stock index, but generate alpha by your outperformance net of income taxes due to an aggressive tax swap. So that was a mouthful. I'll turn it back to you, Craig, to just explain what that means in a little bit more detail as we round out the stock portion today.
Well, let's be real. If you want to do better with your investing, again, it's about real return. The real return, of course, is your return after you pay the income taxes, your return after you pay inflation. And if you're not direct indexing, you're missing the boat for some of your non-retirement money. Remember, whether you buy the S&P 500 mutual fund or whether you buy the S&P 500 exchange traded fund or whether you buy the S&P 500 direct index, all of them are going to track the performance of what? The S&P 500. But the benefit of the direct index version means you're literally going to buy all 500 stocks that make up the index. Now, why would somebody do that? You would do that because in any given year, even like the last 3 years, when the S&P grew at double digits in 2023, 2024, and 2025, lots of stocks fell in value. So why wouldn't you want to invest in all of the upside of the S&P, but get the opportunity to tax loss harvest the losers? Because if you've got a stock index with 500 names in it, and even though it goes up double digits, you may have 200 of those 500 names that lost money. Wouldn't you too want to unlock those 200 tax deductions? That's why if you are a higher net worth investor, you are ready to level up your investment game by moving from mutual funds and ETFs into portions of direct indexing for your non-retirement accounts, your trust accounts. It is where the puck is going. I would argue it's where the puck already is for those that are in the know. And that's why you listen to this show. 833-964-PLAN. That's 833-964-PLAN. Go out to our website. Get retired, stay retired. That's getretiredstayretired.com, because we want you to level up the indexing that you have as a part of your portfolio. David?
And let's talk about two very straightforward applications for direct indexing. One is selling a piece of real estate. Maybe you're selling a rental property, a vacation home. Real estate prices have gone up. And when you sell that vacation home or that rental properties have depreciation. So sometimes investors are getting a large capital gain. One of the benefits of direct indexing is if you're banking some of those losses, those tax deductions, they can be used to offset the gains in other disposition, right? In other sales, right? So that real estate sale. Likewise, if you're one of the great builders of America and you have built a company from the ground up and you're looking to transition to that next chapter and you're going to sell your company, that is likely going to come with a tax hit. How are you going to mitigate the taxes on that sale of the business? Now, Craig, you outlined very straightforward direct indexing, what I call direct indexing level 101 and level 201, but there are direct indexing 301s, 401s for those high net worth individuals that will have a large capital gains exposure. This is something we don't talk about on the radio very often, and we don't need to talk about it here, but we have the solutions to help mitigate that capital gains exposure. It's a similar strategy, just a little bit more in depth, but now we're starting to connect the dots. That's what retirement planning is about how do you sync up two different concepts, selling a company and a stock portfolio, and start creating some synergy amongst them so that you keep more of what you've spent the last several decades trying to build.
I think that's so critical. So you heard it today. It's time to level up the fast money portion of your portfolio by starting to concentrate more on real returns. I believe, as does David, as does everyone at VestGen Wealth Partners, that you should be diversified, but you shouldn't be over diversified because that doesn't make sense. You need to be diversified for a purpose. In those non-retirement accounts, those trust accounts, there's a way to level up your game beyond mutual fund, beyond ETF, into the direct index. And business owners, I'm talking to you. Real estate professionals, I'm talking to you. You need to start building up your participation in great companies of America while at the same time creating that lost piggy bank so that you too can mitigate away or neuter those capital gains taxes when you finally get liquid. And that can be done through your friends at VestGen Wealth Partners. We're a phone call away. That's 833-964-PLAN. That's 833-964-PLAN. Go out to GetRetiredStayRetired.com, GetRetiredStayRetired.com. If you want to have a chance because you haven't interacted with us before, you have a chance. You can see us in person. We've got a calendar of events starting at the 3rd and 4th week of April, where you too can come out to the suburbs, spend an evening with David, and go ahead and talk about how these strategies apply in the real world. Think of it as a classroom learning experience, because there's something to be said for having a whiteboard and a pen in a free-flowing environment so that you too can start getting not just intellectual quotient, but implementation quotient. Because again, getting retired and staying retired, this is all about an implementation business. You're listening to Craig and David Bolanos in the know with VestGen Wealth Partners on AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
Hey, David, we talked about all things that are responsible on the estate side. We talked about the platform people need to start improving into leveling up their game relative to the bonds and fixed income. We talked about how to level up the equities again through proper platforms. But then that part was fast money. There's also, what do we do for those who are concerned about VIX? David, what is VIX, and what are some of the solutions that people can use? Because people deserve sleep at night portfolios.
Yeah, VIX is the ups and downs of the market. And VIX isn't a bad thing when the VIX working in your favor, but when certain world events happen, the VIX makes people uncomfortable. So I think this is the reason why we talk about a lot of different strategies. Number one, when we're talking investment strategies, typically these strategies are dictated by the tax nature of the account. We might use one strategy for an IRA versus another strategy for a trust account. But I think that it's important that once people have internalized that they've made it to retirement, they have enough capital, we need to start having conversations of how we're going to participate moving forward. And the conversation we started having with a lot of families towards the second half of 2025 is, how do we start transferring some equity risk? Meaning, hey, things have worked out pretty well. We had a lot of hiccups along the way, but the stock market's been going up. How do we take some profits and soften up that equity exposure? And there's several ways to do that. I think way number one is what we talk about all the time, is having some more of that dividend focus in your portfolio. Maybe not the high flying tech stocks, but maybe some of the more steady Eddie is a way to go. Creating a little bit more balance in how people are allocated between higher growth names and slower growth names. Second example I use is liquid, which is what we call cap and cushion strategies, using ETFs that participate in the upside of the market, but perhaps have a cushion or a buffer on the downside. Now, the key with that concept is it's liquid exposure through an ETF. It's not an annuity or a product where you're signing a contract. You could buy it one day and sell it the next day if you wanted. But that exposure is designed to help participate in a portion of the market's upside, give you a little ballast on the downside. And where a lot of people are using that, quite frankly, is they're using it because they don't want to sell stocks and sit in bonds. So it's a way to risk reduce your stock portfolio without having to buy a treasury bond. And while
David,
that might not, go ahead.
And David, I got to jump in. I think that's so key because I know there's people that are worried. I remind people that we do believe here that there is still a pathway to a favorable outcome. There's a pathway in the Middle East on the tenures and the stress. There's a pathway to lower oil prices. There is definitively a pathway for jobs to remain fine, for earnings to remain fine, for the economic engine to continue to grow. But I do acknowledge, as do many, that the dual mandate of the Fed is becoming harder. In addition to that dual mandate of the Fed becoming harder, the window for all this to coalesce with a positive outcome is also getting narrower. So the idea that you can have what I call a defined outcome or create these buffers, you called it cap and cushion. David, I was looking at things that launched in April. And in April, you could use a liquid ETF wrapper, like you mentioned, and have a 12% upside with a 15% buffer. Using those specifics, give people an example of what that would have meant to them.
Yeah. So if the market goes up 12% over the next 12 months, you would participate in that full return. The market goes up 20%, you're going to be capped out at 12. But on the downside, if the market goes down in value in the next 12 months, I think you said the buffer was 20%, Craig?
15.
15, excuse me. That means if the market goes down 20%, you're protected on the first 15% of losses. So these aren't the end all be all investments, but these are the satellites that people look to implement where they feel like they're in a good spot financially and they just need to take the edge off a bit. There are complementary strategies, but based off some of the numbers you just said, I could see why there would be demand for an investment strategy like that, especially in today's market environment.
No doubt. And I think part of that demand in today's market environment is making sure people understand something we talked about last week, which is the HELP acronym, David. So we're leveling up people's game. We're diversifying with a purpose. What does HELP mean to all of our listeners, and how can we apply that?
Yeah, well, HELP is the acronym that we use to talk about infrastructure investing. And infrastructure investing is really a play on the whole AI thematic, right? It's a play on this new economy. energy sources. How are we going to power AI? Digital infrastructure, and good old-fashioned utilities, right? Why would we want good old-fashioned utilities? We want long-term contracts with inflation kickers. So the first thing when we think about HELP is a hard asset. Next thing we think about with HELP is essential service. Next up, long-term cash flows. How much visibility do we have moving forward? And that's a really unique concept, because one of the keys with the market now, as all these companies spend money on AI, is people are saying like, look, we understand the opportunity set, but like, what does that look like 5 years down the road? We're not sure. That creates volatility in the market. That's different than having long-term visibility for a utility company that can see with a little bit more clarity to say, hey, look, this is what the demand's most likely going to be. We have all of the data. It's a steady Eddie investment. And the P for HELP, privileged position, right? Something that is not easy to replicate. And you've seen a lot of movement in that. I mean, think about after COVID, there was this race by all these countries to, kind of recalibrate supply chains. People wanted to control the movements. We understand that there's a huge part right now in the Middle East. We need to control the movement of oil, right? Just like people wanted to buy ports during COVID because they wanted to control how goods and services are moving to consumers. So if we implement that HELP acronym into portfolios, it will likely help maybe increase some dividend income, some tax efficiencies, and some diversification away from some of these more popular publicly traded equities.
David, so well said. Listen, I think people want to learn more, and they can and they should. So go out to our website. That's getretiredstayretired.com. That's getretiredstayretired.com. When you're out there, download these very important publications we have, and also take advantage of a complimentary consultation, or go ahead and attend one of our live events. We have some live events happening later in April. You can contact us through that webpage of getretiredstayretired.com. And if you want to learn more about what we do, and you want to learn more about how to create these strategies that we talk about in the platform or radio, that's a wonderful education style event where we can connect in person and talk about all things you need to make sure that you have the confidence, because the strategies you can utilize, the strategies you can have access to are TNT. That means they're tested in the trenches. So David, when we come back, there's another element. It's not just investing. It's not just estate planning. It's always taxation. That's another big part of real return investing is, after all, it's been tax season. What can people be doing to optimize their outcome? I think this is information people can't afford to miss. You are definitely going to want to stay tuned. So you know how to get us, 833-964-PLAN, 833-964-PLAN. You know the website, getretiredstayretired.com. That's getretiredstayretired.com. I'm going to talk to you about what changed with Roth conversions, what you need to do to be gifting intelligently, how you need to rethink charity in a different strategy, all of that and more coming back after the break. Craig and David Bolanos in the know. VestGen Wealth Partners on AM 560. The Answer.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
Let's talk strategy in a rapid fire sense. Strategy number one, David, is what topic?
Gift intelligently.
Quit writing checks to your adult kids and start writing shares of stock. You've got stock. It's made money. I'll bet you this. If you're gifting to those grandchildren, gifting to young adults, if you sold Microsoft, you're probably paying a 15 or 20% capital gain. But look at the tax code, everybody, under President Trump. You can transfer those shares of appreciated stock via a gift to your kids. They can sell them. And what capital gains tax might they pay, David?
They could pay zero, depending on what their income is.
Heck yeah, there's a big difference between 0 and 20%. That's number one. Number two, we call it gift intelligently. Quit writing checks from your checkbook to your church. Start giving stock to your church for the same reason you would want to give stock to your kids. Number two, use a DAF. Donor advised funds are no longer for those who are wealthy. Donor advised funds are for everybody that's charitable. And do not forget, if you are 70 and a half, I didn't say 73, if you're at least 70 and a half, the first check you write, typically the last check you write, is not going to come from your donor advised fund. It's not going to come from gifting stock. If you're at least 70 and a half, even though your RMD hasn't started, you can give money from your IRA doing a qualified charitable distribution. And why in the world are you going to give your church or your charity money from your bank account that you've already paid taxes on when you can give them money from your IRA that you have yet to pay taxes on? Wow, that's called tax leverage. You know what? There is so much more. But David, what's another topic on taxes?
Let's avoid phantom income tax. Stock mutual funds typically pass through capital gain distributions. For some people, that sounds like a good thing. Trust me, it's not. It's what I call a tax drag on your portfolio. And Russell Investments tells us that the last 5 years, big cap stock funds have lost more than 1.5% to that tax drag. There's a better way to do it. Call us and we'll teach you how to get it done.
Amen. So listen, if you're ready to level up your experience, you need something that truly is holistic, then you need to interact with a true family office, a multidisciplinary firm where you can have your investments under the fiduciary standard, your financial planning under the CFP standard of care. You can do your taxes with the CPA. You can do your estate planning with the JD. You can do your retiree healthcare and long-term care with the best consultants in the industry. And more importantly, you can put everybody onto the same Zoom call or in the conference room. You've been listening to Craig and David Bolanos. This is In the Know with VestGen Wealth Partners, AM 560, The Answer.